Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to explore how to analyze an acquisition from the perspective of a shareholder. This approach focuses on understanding the potential impact of the acquisition on the company's value and future performance. We'll look at the critical factors to consider and the kind of questions you should ask to see if the acquisitions are some of the most important choices a management team makes. When done right, they can boost growth, improve competitive position, and create lasting value for shareholders. But when done poorly, they can quickly and often permanently damage value through overpaying, failing to integrate well, getting distracted from core business, or seeing. When shareholders evaluate an acquisition, they focus on 5 main areas. First, they look at the strategic logic, which means understanding how the deal can improve key economic factors like pricing power, reduce costs, enhance the quality of growth, or increase how. Looking at acquisitions through the lens of a shareholder offers valuable insights that go well beyond investing alone. First, it helps leadership teams avoid pursuing deals just because they have the means or feel pressured by competitors or advisors. This approach enforces stronger discipline. When analyzing an acquisition like a shareholder, the first step is to understand the why behind it, but it needs to be measurable. Most acquisition reasons tend to fall into common categories, and as a shareholder, the key question is, which of these categories does this acquisition fit? When evaluating a potential acquisition, it's important to think like a business owner rather than just looking at headline multiples. Start by assessing the quality of the revenue. Does the business rely on consistent recurring revenue or on one-off transactional sales? Check if there's a heavy dependency on a small group of customers, which could be risky. Next, understand the gross margin structure to see if the company has pricing power. Management teams often point to EPS accretion to show a deal is beneficial. But shareholders understand that EPS can be manipulated in several ways. For example, using cheap debt can temporarily boost EPS. Accounting treatments like amortization and purchase price allocation can distort reported earnings. And activities like share buybacks or issuing new shares can mechanically shift the price of an acquisition. Isn't just the headline purchase price you see. You need to factor in the equity issue, which dilutes existing shareholder stakes. Then consider any debt the company is taking on, including off-balance sheet liabilities like leases or pension obligations. Integration costs matter too, things like updating systems, severance payments. When evaluating a valuation, it's important to remember that multiples can only give you a rough idea. They aren't definitive answers. You need to look at the target from several angles. First, consider the standalone value, which is based on the business's cash flows without any potential deal effects. Then, think about the deal valuation, including synergies. How much extra value comes from combining operations? When looking at an acquisition from a shareholder's perspective, the key question is whether the deal actually strengthens the company's competitive advantage or just increases size without real benefit. Good acquisitions usually improve important areas like pricing power through a stronger brand or customer loyalty, reduce costs by creating structural advantages, expand network effects by growing platform. How a deal is financed plays a big role in the risks the company takes on after an acquisition. Using all cash or debt can avoid diluting current shareholders and may have tax benefits, but it also increases the company's leverage. Integration often determines whether an acquisition succeeds or fails, even when the deal itself makes sense and is fairly priced. From a shareholder's perspective, it's important to carefully evaluate the complexity of integrating systems like. It's important to assess the credibility of the management team behind the acquisition, because shareholders ultimately trust their judgment and incentives. Look at their past track record with mergers and acquisitions. Did previous deals create value by improving returns on invested capital, or did they destroy value? Pay attention to how they communicate. Do they provide clear, specific? To make a sound acquisition decision like a shareholder, It helps to use a straightforward scorecard focused on 5 key areas. First, look at the economics by asking whether the return on invested capital will surpass the cost within 3 to 5 years. And if Disney's acquisition of Pixar shows how gaining key creative capabilities can revitalize a company's core business, not through immediate earnings, but by restoring the quality of franchises and boosting long-term cash flows across films, merchandise, and parks. This teaches us that capability acquisitions can add value when they strengthen the company's competitive advantage, but careful cultural integration is. Analyzing acquisitions like a shareholder prioritizes actual value creation over just telling a compelling story, which helps prevent overpaying based on optimistic narratives. It encourages disciplined use of capital by being willing to walk away from deals that don't meet clear return targets. This approach also improves risk management by forcing a thorough look at potential. Some challenges when analyzing acquisitions include the difficulty of measuring strategic value, since certain advantages like capabilities or platforms can be hard to quantify. To address this, using scenario analysis and thinking in terms of option value helps. But it's important to remain conservative. Accounting can also distort evaluations because purchase accounting, amortization, when analyzing an acquisition, it's crucial to think like a shareholder by focusing on whether the deal truly increases the intrinsic value per share. This means looking closely at how the transaction will improve sustainable cash flows and returns on capital. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.